So here's a question for you. In an era where AI, artificial intelligence, is rapidly becoming, well, almost a commodity, can a company build a truly lasting, maybe even monopolistic advantage? Not based on the AI itself, but on the actual operating system that governs how big companies and governments make their most critical decisions. That really is the central question facing Palantir Technologies right now. Is it just riding the AI hype wave temporarily? Or is it carefully, methodically building something permanent, like an indispensable layer deep inside the global tech stack? A position that, maybe, could justify its absolutely monumental valuation. Welcome to the Deep Dive. We're here to unpack complex topics and give you the essential knowledge you need. Today, we're diving into Palantir Technologies, Inc. You'll find them on the NASDAQ, ticker symbol PLTR. And our mission today is to really dissect this company piece by piece and help you answer that crucial question about its real value.
Absolutely. And we've pulled together a pretty extensive stack of sources for this deep dive. Everything's current as of market close yesterday, July 9th, 2025. Palantir's Classic Common Stock closed at $139.75 per share then. So we'll walk you through their business, the management team, financials, how the market feels about them, who owns the stock, and of course, the key risks involved.
Okay, and we've structured this deep dive into two main parts just to keep things clear and manageable for you. In part one, we'll tackle chapters 1 through 3. That's business understanding, management, and the financials. Then in part 2, we'll move into chapters 4 through 7, exploring market sentiment, ownership, the risk assessment, and finally, our conclusion. And just a quick note before we jump in, if you're finding this deep dive valuable, please do remember to like and subscribe to the Stock Analytic AI YouTube channel. For just €4.99 a month, members get priority deep dives on specific tickers. We're actually covering all of the S&P 500 stocks over the next few months, and members get that exclusive priority access. Or if you just want a one-off deep dive, focus on something specific for you, just drop us a super note. Thanks. Okay, let's get into it.
Business understanding.
Right, let's start by really understanding Palantir's core business. So what exactly is it they do, and how do they make their money?
Well, Palantir's business model is pretty unique. It operates on this three-phase customer engagement strategy they call acquire, expand, scale. So in acquire, they invest quite heavily, sometimes even taking a loss initially just to get their platform into a new organization. This is especially true for smaller commercial clients.
Okay, getting a foot in the door.
Exactly. Then comes expand. This involves these highly skilled engineers, they call them forward deployed engineers, working right there on site. Their job is to deeply integrate the platform into the client's really complex data environments. It's a very high-touch, consultative process. That's a key differentiator.
Right, much more involved than just selling software.
Definitely. And finally, you hit the scale phase. By this point, the software has become indispensable. Clients start building their own apps on top of it. And the relationship becomes highly profitable for Palantir. That profit then helps fund the next acquire phase with new clients. It's a cycle.
Fascinating. So it's really not just a simple subscription model at all. How's their revenue actually split between different kinds of customers?
Yeah, their revenue comes from long-term contracts, primarily with two big groups, government and commercial entities. The government segment, that's really their bedrock. It accounted for 55% of their revenue in fiscal year 2024. We're talking agencies like the US CIA, the DoD, NSA, FBI, using Palantir for really mission-critical tasks.
Okay, so that provides stability.
It does. Then you have the commercial segment. That was 45% of revenue in 2024, and it's really their main growth engine right now. They're targeting large enterprises, companies like Ferrari, Airbus, Merck, helping them optimize really complex operations. So this dual market approach gives them both that stability from government contracts and potential for aggressive expansion on the commercial side.
Okay, let's unpack this a bit more. What are the actual products or platforms that Palantir offers? What are these tools?
Right. So Palantir offers a pretty cohesive ecosystem of four main interconnected platforms. First, there's Palantir Gotham. This was their original platform, built specifically for the U.S. intelligence community. It's really good at integrating huge amounts of unstructured data for things like counterterrorism or criminal investigations.
The original spy tool, kind of.
You could say that, yeah. Then there's Palantir Foundry. This is their flagship enterprise platform now. It's designed to be the central operating system for a company's data. It lets even non-technical users build data pipelines and operational applications.
Making data usable for everyone.
Exactly. Running underneath both Gotham and Foundry is Palantir Apollo. Think of this as the engine room. It's powerful, it's cloud agnostic, meaning you can run anywhere, and it automates deployment and management. That's a huge technical advantage. And finally, the newest layer is Palantir AIP. That's their artificial intelligence platform. This is really important. It basically bridges the gap between theoretical AI, like these large language models everyone talks about, and actually using them in day-to-day operations. It lets companies securely deploy AI models on their own private data, automating workflows, driving decisions, but with strict guardrails.
So making AI practical and safe for businesses.
Precisely.
Yeah.
What's really interesting here is that AIP, combined with this new bootcamp sales model they're using, seems to be tackling Palantir's historical problem with scaling their sales quickly. They're aiming to sign, seven-figure deals in just weeks now, which is a big change for them.
So putting it all together, where does Palantir actually stand in the market? What's its scale and its core value proposition?
Palantir really occupies a unique space in high-end data analytics, especially in these complex, high-security environments. By the end of fiscal 2024, they serve 711 customers across 90 industries. That includes 55% of the Fortune 500 and 21 of the G20 countries.
That's significant reach.
It is. And their main value proposition isn't just crunching numbers. It's about creating this decision-making layer that essentially becomes an organization's central nervous system. It empowers the human decision makers. These solutions are highly tailored, highly customized, and that creates extremely high switching costs for customers. They become incredibly sticky.
That makes a lot of sense. What about competition, though? And how hard is it for others to break into this space?
Well, they face competition from a few different angles. There are internal IT departments trying to build things themselves. You have the big tech cloud providers like Microsoft Azure or Amazon AWS, although they're generally less specialized in Palantir's niche. Then there are data platform specialists like Snowflake and Databricks, but they're often more foundational, less about the end application, and BI tools like Tableau, which lack that deep integration.
So a varied landscape.
Very. But Palantir has built some pretty formidable barriers to entry. Those extreme switching costs we mentioned are huge. Plus, they have trust and security clearances built up over 2 decades, especially with governments, which are almost impossible for a newcomer to replicate quickly. Add in the immense technical sophistication needed for data harmonization at their scale and the long, complex sales cycles. It really deters typical software as a service competitors.
Management evaluation.
Okay, now let's shift our focus to the leadership. Who's actually steering the ship at Palantir, and how have they handled some of the, let's say, public controversies the company's often associated with?
Well, one thing that stands out about Palantir's leadership is its stability. It's quite extraordinary, actually. It's still led by the co-founders. Alex Karp is the CEO, Stephen Cohen is president, and Peter Thiel remains chairman. Alex Karp in particular, he's quite notable for his, let's call it a philosophical contrarian approach. He's often very candid, maybe even skeptical of what he sees as Silicon Valley's performative ethics.
So not your typical tech CEO, then? Not really, no. And this unconventional style definitely shapes the company culture, which seems very focused on long-term, high-consequence projects rather than quick wins.
Right, and this is where it gets really interesting. The sources we looked at highlight several major controversies. How has the management team actually responded when these issues flare up?
Their general strategy seems to be to, well, almost lean into the crises. They argue their software is, quote, built and tested in crises. And they point to examples in humanitarian aid or pandemic response efforts to back that up. But yes, they've definitely faced significant controversies.
Like to work with ICE.
Exactly. Regarding their IC contracts, Immigration and Customs Enforcement, management has consistently defended that work. They frame it as a patriotic duty. They've stated that abandoning those contracts would make Palantir seem like an unreliable partner to other government agencies. They claim the contracts are limited just to criminal investigative divisions, and they've said policies like family separation are abhorrent.
But that's been challenged.
Heavily. Critics like Amnesty International allege Palantir's tech was used in raids that led to those separations. So defending those contracts, it seems like a calculated business decision, primarily to signal dependability to their core government clients, even amidst the criticism.
Okay, who else?
Well, back in 2018, during the Cambridge Analytica scandal, there was a whistleblower who alleged Palantir employees helped build data models using improperly obtained Facebook data. Management's response was swift. They denied any corporate relationship, said any involvement was down to a single employee acting in a personal capacity, and they launched an internal investigation. They also made a point of showing they had previously rejected business proposals from Cambridge Analytica itself.
Try to distance the company.
Right. And then much more recently, just in May 2025, there was a New York Times report alleging Palantir was central to a potential new Trump administration plan for a surveillance database on Americans. The company issued a very fast, very forceful public rebuttal. They called the article blatantly untrue and flatly stated they never collect data to unlawfully surveil Americans.
So a pattern of strong defense and positioning. How does this philosophy translate into their capital allocation strategy?
Yeah.
How do they decide where to put their money?
Palantir's strategy heavily favors organic growth growing from within and building out their ecosystem. A really substantial chunk of their capital goes into R&D, research and development. Historically, it's been over 30% of revenue.
That's a lot.
It is. And their history of mergers and acquisitions, M&A, is remarkably sparse. That tells you they have a strong build not buy philosophy when it comes to core capabilities. Instead, they focus on deep strategic partnerships. Think IBM, Amazon, Microsoft, Fujitsu, embedding their platforms within those larger ecosystems.
Extending their reach that way.
Exactly. And a really significant recent example is a partnership announced in June 2025 with Accenture Federal Services. The plan is to train 1,000 Accenture professionals on Palantir's platforms. It's a very capital-efficient way for Palantir to scale up their sales and implementation capacity, specifically for the huge U.S. government market. Oh, and they also made those somewhat unusual investments of over $400 million into SPACs back in 2021. The idea there seemed to be twofold: getting investment returns and potentially gaining those SPACs as new customers.
Okay. And what about returning value directly to shareholders? Are they doing share buybacks or paying out dividends?
They do have an authorized share repurchase program. In 2024, they bought back about 2.1 million shares for roughly $64 million. And there's still authorization for almost $1 billion more, around $935.8 million left.
So some buybacks,
Yeah.
dividends.
No dividends. Consistent with, being a high-growth tech company, Palantir has never paid a dividend, and they haven't stated any policy or intention to start doing so. For investors, the expectation is that returns will come purely from the stock price going up, from capital appreciation. And this brings up a really important question. Is this overall strategy actually working? Is it paying off financially? A key metric to look at here is return on invested capital, or ROIC. For years, Palantir's ROIC was negative. They were essentially spending more capital than the returns they were generating.
Earning cash.
Right. But as of July 2025, their ROIC stands at 10.15%. That positive number is a really significant milestone. It signals that the company is now generating profits in excess of its cost of capital. It suggests their business model is finally scaling efficiently and starting to create real economic value.
Financial analysis.
All right, let's get into the hard numbers now. How big is Palantir really, and what do the financials tell us about its health and direction?
Okay, so as of July 8th, 2025, Palantir's market capitalization is, well, it's colossal, $330 billion.
Wow, $330 billion.
Yeah. And that figure, it really reflects the market's monumental expectations for its future, for its dominance. That's a theme we're going to see coming up again and again in this analysis.
That's a truly enormous valuation. How has their actual revenue growth been looking recently?
Palantir's revenue path shows impressive growth and actually accelerating growth more recently. It's time to moderate a bit in 2022 and 2023, but the launch of their AI platform, AIP, seems to have really reignited things.
So what are the numbers?
Okay, back in 2020, revenue was $1.09 billion. That was 47% growth. By 2024, it reached $2.87 billion, which was about 29% growth that year. But then, for the trailing 12 months ending March 31st, 2025, revenue hit $3.12 billion. That's up 33.45% year over year.
So ticking back up.
Definitely. And the first quarter of 2025 was particularly strong. It showed a significant 39.34% year-over-year growth rate. That reacceleration is really catching people's attention.
That jump in growth is certainly eye-catching. What about profitability, though? Are they actually making money on a consistent basis now?
Yeah, the story of Palantir's profit margins is really one of rapid maturation. They've genuinely shifted from being a cash-burning entity to a profitable enterprise. Their gross margin has always been pretty high, consistently stabilizing around 80%. That suggests strong pricing power for their products.
Oh, okay.
But the operating margin, that shows a really dramatic shift. After years of deep losses, they finally achieved a positive GAAP operating margin in 2023, only 5.4%, but positive. Then they expanded it significantly in 2044 to 10.8%. And in the most recent quarter, Q1 2025, it surged to nearly 20%. That demonstrates powerful operating leverage as they scale.
Meaning, as revenue grows, profits grow even faster.
Exactly. And following that, their net profit margin has turned sharply positive too. It reached 16.1% in 2024 and an impressive 24.2% in Q1 2025. It really signals a new era of profitability for them.
So the trend across the board is moving firmly in the right direction. How does this translate into free cash flow? That's often seen as the ultimate measure of financial health, right?
Right. And the free cash flow generation picture is perhaps even more compelling. The company went from burning over $300 million back in 2020 to generating over $1.1 billion in free cash flow in 2024.
That's a huge swing.
Massive. And for the trailing 12 months ending Q1 2025, they generated over $1.3 billion. This really is a testament to their business model becoming highly scalable and profitable at its current stage. It's a core pillar of the bull case for the company. And what's fascinating here, linking back to strategy, is that this shift to consistent GAAP profitability, which they first hit in Q4 2022 and have maintained every single quarter since, wasn't just a financial achievement. It was also strategic. It was the key that unlocked their access to a vast new pool of institutional capital because it made them eligible for inclusion in the S&P 500 index. That happened in September 2024, and it basically forced all those big index funds to buy the stock.
Ah, right. That's a powerful tailwind indeed.
Yeah.
What about their balance sheet overall, financial stability?
Their balance sheet is like a fortress, honestly. Palantir is effectively debt-free. Their debt-to-equity ratio is negligible, somewhere between 0.0 and 0.05. And they're sitting on a massive hoard of cash and short-term investments, $5.4 billion.
Wow.
Yeah. Plus, their current ratio, which measures short-term liquidity, is 6.49. That just further confirms their exceptional liquidity and near-term stability. They have plenty of resources.
Okay, all these numbers look really strong. Impressive turnaround. But let's talk valuation again. How does Palantir's stock price actually stack up against these improving financials?
And this is where the conversation really pivots. It shifts to, well, extreme market expectation. Palantir's valuation metrics are, by any conventional measure you look at, just astronomical. As of July 9th, 2025, their trailing 12-month PE ratio, price to earnings, ranges anywhere from 537 times earnings up to 781 times earnings.
500 to 700 times earnings.
Yeah. And even looking forward, the forward PE is around 193x. That's more than double its own historical average since it turned profitable. And it's just in a completely different stratosphere compared to software industry peers, which average around 72x, or even tech giants like Amazon at roughly 36x, or Microsoft around 38x.
Okay, so massively higher.
Massively. This extreme valuation basically signifies that the market has priced the stock for absolute perfection, flawless execution, decades of hypergrowth. There's virtually no margin left for error at this price.
So if the market's PE multiple is just so incredibly high, how can we try to get a better handle on its, intrinsic value, what the company might actually be worth based on fundamentals?
Right. To try and look beyond these sentiment-driven multiples, we often turn to something called a discounted cash flow analysis, or DCF. Basically, this method tries to calculate a company's true intrinsic value by projecting out all its expected future free cash flows and then discounting them back to what they're worth today. It's grounded in operational drivers, revenue growth, margins, reinvestment, but it is highly dependent on the assumptions you make about the future.
Okay, so what do DCF models suggest for Palantir?
Well, if you review several publicly available DCF models for Palantir, you see a pretty wide range of estimated values. That's because people make different assumptions about growth and risk. But they consistently point to a significant gap between the current stock price and that estimated intrinsic value. If we synthesize these models, a broad estimated intrinsic value range comes out somewhere around $35 to $85 per share.
$35 to $85 compared to the market price of nearly $140.
Exactly, $139.75 as of yesterday. It highlights a really substantial disconnect. The wide range in the DCF estimates, that's driven mostly by different guesses on future growth rates. People typically model maybe 20-30% growth initially, slowing down to 2-3% forever, and the discount rate used maybe 10-12% seems reasonable for a high-growth tech stock like this. But no matter how you slice it with reasonable assumptions, the DCF tends to suggest the current price is well above the fundamental value based on projected cash flows.